What's up, guys? Today we're talking about HODLing and yield farming, the pros and cons of each, and which one is better. It's typically a great idea to use both strategies, and I personally prefer yield farming. That's where I've made most of my gains, and I will explain why in this video. If you're new here, my name is Richard. This channel is about yield farming and investing, and I want to update you guys on my portfolio really quickly. Sitting in really nice profits here at 10.32 ETH on my main wallet. Bonk has been doing really well recently. You can see here some of the positive divergence loss here in Ethereum terms because it's trading above my entry. And you can see the fees have been picking up pretty nicely. Yesterday, I've made over $500 in fees here in just one day. So sometimes there are going to be a lot of opportunities where we could be making a lot of fees. And these other positions are chugging along here. MOG is doing well. This position is still sitting in a loss. It's a rebalance position, so it doesn't show. And sometimes I do make the wrong decisions. As you can see, this position is sitting in a loss. But overall, if I change my reference value here to compare against holding, I'm still up 19,000 something dollars. And because the market has been trending up, the US dollar value of these positions are up pretty nicely as well. And the close position here sits at 8.6 ETH. It's the same as before. I've closed my leverage yield farming position for roughly 1,000 something dollars worth of profits. And if we look at Ethereum's price, it's kind of moving up towards its upper range here. So I'm starting to de-risk a bit and hop into more crypto to stable pools like Ethereum to USDC. This is the time, in my opinion, to start thinking about taking profits and keep stacking stablecoins while the yields are hot and the market is trending up. And a quick disclaimer here, none of this is financial advice. Please do your own research before you invest. So let's dive right in. Let's go over the cons first of buying and holding. The first major one here is there's no profit until you sell. And this doesn't matter if the token has been doing really well, right? To actually make a profit from your tokens, you actually need to sell out of your holdings or borrow against it to be able to spend the gains that you've made, right? And sometimes if you're trying to trade and time the market, but you're not that good at doing so, you could be missing the entry and exit targets. For example, if you were buying Ethereum here at 2,500, you would still be in profit right now. But if you bought at like $4,000, for example, thinking that Ethereum would go up to 10K during last year and you've spent all of your investing capital, you're still sitting at a slight loss, right? So there is more of a market timing risk. And one way to easily reduce that as well is we simply dollar cost average, right? If you guys were buying the top here and you bought all the way down and then all the way up, you will still be in profit here. If we just look at this 50-period weekly moving average, right? At first, you're probably going to be in a loss if you bought the top of the last cycle. But as you average down your entry, your cost basis is going to be better and better. So buying and hold is definitely a great strategy as well if you remove the market timing risk and you're doing it with solid assets. But again, it's very easy to miss entry and exit targets. We never know how high a token is going to go. For example, Ethereum right now is sitting at 33.47. I personally think Ethereum would go to at least $8,000. But at the same time, we can never be certain, right? There's just too many factors in the market. If somehow the macro market condition gets worse, then it's very likely that these assets would be sold off as well. When we're buying and holding, there's less margin for error. If we're trying to swing trade with the strategy, right? Like I've said before, it's very easy to make mistakes, especially if you're not dollar cost averaging in and out of the market. There's less consistent profits because you can still make mistakes. Sometimes targets just miss. I've seen a ton of people waiting for like a dip and then they try to wait lower and then they just miss the targets, right? So it's not as easy as people think to be swing trading or to make really consistent profits while buying and holding. And this is especially true for altcoins. When we have to be more aggressive in profit taking, sometimes tokens pump really hard. And then if you miss your exit targets, you could still be sitting at a loss, right? For example, last year, this dog with hat meme coin was really big. It reached a couple $1 billion market cap, and then it was trading at like $4 to $5 there. And now it's still trading at one something dollars, right? So still a lot of room to recover if it ever recovers back to its previous high. So there's a lot of market timing risk there. There's a lot of chance that you're going to be buying like the top. And then if you didn't get your exit, you could be still at a loss, right? So the profits are definitely less consistent. There's no cash flow until you actually sell or you borrow against your assets. So these are the main downsides here. And really the main thing that I don't like about buying and holding only is because the profit is just not as consistent. And that is very hard to balance like when you want to buy and when you want to sell, right? When you sell, you feel a little bit underexposed. And if the market drifts higher, you're feeling FOMO, right? So it's a little bit harder to manage, but it's still a very profitable strategy to use. It's easy to understand and manage, right? If you just dollar cost average into solid assets like Bitcoin and Ethereum, it's very likely that you're in really nice profits here. This strategy works really, really well with blue chip assets like the stock market. We see the S&P 500 just keeps drifting upwards over this period of years. If you just dollar cost average into the market, you're going to be making a ton of gains here. Even if the market went flat for periods of years here, you can see in the dot-com bubble, the market actually did not trade above its high until back here in 2012, 2013. So it's over like a period of 10 years, right? So if you just bought and hold the top, of course you would underperform. But if you actually bought all the way down and then bought all the way up and then buy all the way down over time, as long as the assets are solid, then your portfolio would be able to grow, right? And this is why I also like this strategy a lot. It's great for dollar cost averaging into the blue chip assets for longer term investment that you're willing to hold at least 5 to 10 years or even 10 to 30 years. It's great for swing trading and cycle trading as well. The examples I gave earlier for the cons, a lot of it is talking about swing trading, right? We're trying to capture a swing upwards. For example, if we're buying meme coins here, I'm currently yield farming bonk, right? But you could have swing traded this chart as well. You buy when the prices are cheap, you take profits on the way up. And then when the prices are cheap again, you could buy into the market again. And then you just take profits on the way up again, right? So that's a great way to be making money from crypto, especially on solid projects that you believe is going to be around for a long time, because crypto is very volatile, which makes it really great for swing trading. If the asset just moves up over time, like the S&P 500 here, I probably would not be swing trading this chart, because if I just sell here and the market just keeps drifting upwards, I'm sidelined, then I would need to park my cash somewhere else, right? So really, crypto is really great for swing trading if you know how to trade. But again, we got to keep those downside in mind, right? There's less margin for error, there's less consistent profit, and sometimes you guys sit in a lot of unrealized loss before you actually turn into a profit, similar to yield farming. So now let's look at the yield farming pros and cons here. The first drawback of yield farming is that there's a little bit of a steeper learning curve. We have to worry about stuff like impermanent loss, the APR, how do we pick good assets, how do we actually set our ranges, right? What's the sizing that we have to take? So those are all like important things to learn. And this is what I try to teach on my YouTube channel here so that you guys can actually be more consistently profitable. There's something called an impermanent loss. If you don't know what that is, it's basically if we're providing liquidity for something like Ethereum to USDC. If I entered all the way at $1,500, for example, with some USDC and some Ethereum, as Ethereum's price move upward, if my funds are in the liquidity pool, it's going to slowly get sold into USDC, right? So in that case, if the price moves up pretty aggressively, like what we saw in the last few weeks, I'm likely underperforming just buying and holding. So that's the impermanent loss that I'm suffering. It's comparing your performance of the funds you deposited into the LPs compared to your buying and holding performance, right? If you guys go back to my portfolio here, you can see I'm actually beating impermanent loss pretty comfortably. And I will share with you guys a few tips at the end to help you beat buying and holding in the market. But that's the main reason why people actually never got started with yield farming. They hear about impermanent loss, they don't understand what it is, they got intimidated, and then they just never looked into it and think that it's not worth it, right? If you guys want to learn more about impermanent loss, just go to my channel and search for impermanent loss. I've made a few videos about it, but it's not something to be feared. It's fairly easy and simple to beat, and you can actually profit from the impermanent loss, right? One simple example is the Ethereum and USDC example. If I entered even here at 1500, if my goal was to actually sell Ethereum on the way up in the LP, then I don't mind the impermanent loss, right? Because my goal, again, is to just slowly sell my Ethereum on the way up. That's how you can use the liquidity pool to basically earn fees in the process and make the buying and selling process more automated. And then there's less of a need to time the market, right? It's not really suitable for short-term trades. If you're a day trader or if you're trading meme coins where you might want to be in and out in like a few days or a few hours, then this strategy is typically not that great for it. It's mainly for accumulating assets that you want to hold at least for 6 months. And there's some smart contract risk as well. You're interacting with protocols like Uniswap, but you could always buy some insurance against that if you're worried about the safety. And then here are the pros that you can consider when you're yield farming. The first is the impermanent loss doesn't really matter if you're net profitable. Like I've explained in the Ethereum to USDC, for example, if your goal was to make a USDC profit, then it doesn't matter if you suffer some impermanent loss, right? And it works the same way with crypto to crypto pools as well. For example, this Bonk to ETH pool. If Bonk goes parabolic and does like a 10x against Ethereum, for example, I would suffer a lot of Ethereum divergence loss. But at the same time, my goal is to make a net Ethereum profit. So I don't mind that happening. You can see if this number is positive here and it's green, it means that I've entered at a lower price. In this case, I went in around this price at 0.000006, and now it's almost 2x my initial price, while I'm earning some really nice fees in the process, right? So you can profit from impermanent loss if you can get really good entries, especially on assets that could trend up over time. The biggest benefit with yield farming is that you have cash flow. Last month, I generated only $2,000 something, but most months I'm able to generate at least $4,000 on my liquidity pool. If there's average volume, for example, this month, the volume is pretty high. So we're not even at the end of the month yet, and I'm sitting on $3,000 something worth of fees. And those fees I could use to pay for my expenses or to buy other assets like more Ethereum or Bitcoin. It's a really great way to actually earn a yield on whatever tokens that you hold, rather than just sitting in the market and just not putting it to work. As long as people trade these tokens, you're going to be earning those tokens, right? Because every time people swap on decentralized exchanges, they are paying an exchange fee to the liquidity providers like ourselves, and then you're able to accumulate the tokens that you want. And if you guys don't like meme coins like MOG or Bonk, then we could be providing liquidity for stuff like Wrap Bitcoin and Ethereum as well, right? So the strategy could be really different depending on what you're trying to achieve. Or if you like smaller cap tokens, you could do that as well. There's also more margin for error. If I look at this MOG and ETH pool here, you can see my first initial deposit, the price actually trended down a little bit more before bouncing back up. So during that time, what I did was I compounded more aggressively when the prices are low. And then now that the prices are above my entry, the prices are trading really good. There's an Ethereum divergence loss here. I could aggressively take profits on my fees here and de-risk my investment. So that's typically my strategy here. Enter when the prices are cheap and then de-risk more aggressively when the prices are high. So there's much more room for error here. Because if we pull up a lot of different pairs, for example, let's say Aerodrome and Ethereum, you can see the outperformance and underperformance kind of bounce around here, right? So if you were just buying and holding and you buy at this green line here, you might still be sitting at a loss. But if you actually entered at this green line, let's say here of last year, prices went down, you compounded your fees, what that is going to do is actually drag down your entry a little bit. And then when the prices are high, you actually de-risk and sell some of your fees. So then your cost basis gets lower and lower, right? And then when the prices are low once again, you compound a little bit more of your fees, and then now you might be sitting at break even or at a nice profit just by following that strategy, right? Versus buying and holding, if you didn't take profits, you could still be sitting at a loss right now or sitting at break even if the prices never moved up. So if you guys have round tripped a lot of gains here, then yield farming could be a great way to prevent that, especially if we're holding for alt season, right? Where Bitcoin dominance drops really hard. You can see it's starting to come down here, but we actually don't know if it's going to crack down that hard until it actually happens, right? So if we're holding for like the ultimate pump, a lot of times we're going to be missing out on like the swing trades. So then yield farming is a great way to accumulate those assets until you ultimately sell for higher when alt season finally comes around. And lastly, there is compound interest. That's how I was able to grow my portfolio really quickly. If you look at my current portfolio, it's sitting at around 200 something K. When this bull run just got started, my portfolio was sitting at roughly only 40 to 50K. And then now I've been able to make really great gains simply by yield farming good assets and taking profits on the way up, and then redeploying my assets when the prices are cheap once again. So I've found most of my success here from yield farming, but again, I do employ both strategies. I do believe it's great to have both because buying and holding is just very simple and straightforward, right? What I usually do is take a portion of the fees that I generate from my yield farming and then allocate towards my HODL portfolio. In most cases, it's Ethereum and Bitcoin, but sometimes when the prices are drifting higher, like what we're seeing right now, Ethereum is closing in on $4,000, potentially pushing to $5,000. So this is a price level where I'm comfortable selling a lot of my fees into stablecoins, especially if I'm yield farming crypto to crypto pairs, because if the market does draw down, I could then use those stablecoins to buy more solid assets, right? So both strategies work really well together. And I think it's great to do both. So if you guys are just buying and holding, I think it's great to look into yield farming. And if you're only yield farming, I think it's also great to use some of your fees to buy and hold assets when they're cheap, and then to take profits when the prices are high. And before I hop off here, I want to talk about why you might be underperforming holding and what to do instead. So one major reason why is that you might be picking assets that are underperforming Ethereum if you're providing liquidity for Ethereum pair, or it could be Solana if you're yield farming Solana pairs. So then you're bleeding out Ethereum or Solana, right? What we want to do is try to look for assets that either bounce between like underperformance or outperformance, or just likely to outperform over time. And sometimes we don't get it right. So then that's why we diversify. If you guys look at my current portfolio here, you can see Pixel and ETH has been doing really well. Bonk has been doing well, MOG has been doing well, but this one is still sitting in a loss, still trying to recover from it, as well as this AI XPT one. So we're not going to be perfect, right? Sometimes we do get into like different pools at a higher price than anticipated. The prices drop, and so then we're going to be suffering more divergence loss here. If I look at this Ethereum value, this is a negative divergence loss in Ethereum terms. And against holding, it's going to be harder to actually outperform if you're losing a lot of value and the APR is not enough to cover the divergence loss, right? So that's the first thing. If we pick better assets and we get in at a good price, our chance of making a profit is much higher. The second thing is we want to set wider ranges. If I pull up this impermanent loss calculator here, and if you guys want to try using this, the link is in the description. And let's use Ethereum and USD to demonstrate this example. So let's say we deposit $100 here, and let's change the price now and price deposit to be 3350. That's near our current price. And then let's say I have a tight range LP here at 3,000 to 3,800. This is a pretty tight range LP. And what we can see here, the blue area is the impermanent loss that we're going to suffer. Again, impermanent loss is comparing the benchmark against holding. So if you held your assets separately, the right value is what you would have. And if I change the price now, you can see if Ethereum goes up to 10,000, the impermanent loss is around 49%. Which is pretty high, right? And let me show you guys an extreme example where the price lower is at 0. Price upper is at infinity here. You can see even if Ethereum 3x from its current price, the impermanent loss is only 13.3%, right? So in theory, if your APR is greater than your impermanent loss, then you're going to be beating holding in the market. And I want to share this example really quickly here because a lot of times people just set the ranges too tight, and that's how you could be underperforming holding, especially if the volume does drop. And it always does, especially if the market is really quiet. That's when we could be suffering a lot of impermanent loss and not actually have enough fees to cover our losses, right? And lastly, we want to stay in range for a long time. So impermanent loss cannot actually be greater than like 100% unless the price actually goes to like absolutely zero, right? Which would not happen on solid assets. So then if you're in range for a very long time, even if your APR is low, you're likely to be holding in the market. So let's say this impermanent loss is 5% here. If Ethereum moves up to 62.90 and you have a full range LP, but your yearly APR is 10% per year, right? You only have to stay in range for 1 year to actually outperform holding in the market. And if you're actually providing liquidity for like 3 to 4 years, then it's very likely that you're going to be comfortably beating holding in the market. And this is especially true for higher APR pairs. You can see stuff like Bonk that is pulling like an 80% APR, right? If I stay in range for at least a year or so, I'm going to be easily beating impermanent loss, especially on a wider range. So if you just do these three things and diversify which pairs you actually yield farm, it's very likely that you're going to be outperform holding in the market. So really, impermanent loss is not that big of a deal. So that's pretty much it for this video, guys. Pretty straightforward. There's no one thing that is like best for everyone. Sometimes you're just more suitable to be buying and holding and not worry about like yield farming. But for me personally, I find that yield farming, I could generate a lot of gains, but I also use buy and hold strategies to boost my return and to take profits. And in my opinion, that's the best for most people because it removes the need to time the market perfectly, and we can build our blue chip portfolio really quickly if we actually generate a lot of yield, right? If you guys want to learn more about yield farming and how to generate consistent yield without actually losing your initial capital, then be sure to check out my channel. There's a lot of misinformation in DeFi and yield farming, so I try my best to put out the best information. If this is something that you're interested in, then check it out. Thank you for watching. I'll catch you guys next time.